So this question came in, I think we got it from a group originally, from the Facebook group. But the question is, how are you handling rate rises?
Charlie, how are you handling rate rises? Because you've got a really interesting response.
I actually do for this. Put a lot of prep into this question.
No, I know. That's what I'm like, I don't want to take anything away from it.
All right. So to give this some context, I have not enjoyed the first Tuesday of the month in quite a while.
Except for January.
Actually, January was lovely.
It's a great day.
Really, really lovely.
On the beach.
Yeah, because when you do have a larger portfolio and a larger amount of debt, these 0.25 or 0.5 rate changes make a significant difference to cash flow. And as much as I am buffered up and I'm still well and truly in positive cash flow, I still don't enjoy having to measure it every month of seeing it go down compared where it would have been or was previously, I should say, from there. Now, I really believe that one of the best things about property investing is it's a semi-active sport.
Yep.
So, for example, it's like if I have, and this is only example, not advice, but it's like if you buy shares, like how much can you really influence the company you have shares in?
Maybe as a Coke, but...
Well, you know what? If you did, I buy a lot of Apple products. If I had shares in Apple, maybe I could influence that one a little bit, keep them going, repping the brand.
Good luck.
What do you mean? I'm an aspirational figure. I'll just flex my Apple Watch here and say, maybe everyone should go out there and buy one of these. Help me out. Actually, I don't have any Apple stock. That wouldn't do anything.
Sound like you. It's not going to help you at all. Besides make you feel good.
Anyway, so I got to this point. This was in December where it's like we'd taken enough rate rises by this point. I'm like, there's got to be something we can do about this. There really has to be something to do about this. And I think for a lot of people, when they think of that, they're almost leaning to the idea of the default answer. It's like, yeah, get onto the phone to your bank and, negotiate a better rate, which does work, by the way.
I've heard that on a lot of podcasts.
Well, I'm not going to give the obvious answer here. I'm not, because I think that if that type of thing just gets repeated and it's obvious, and I feel like a lot of investors out there would have already done that.
Totally.
Now, I started to think about this a little bit more deeply, and there was a lever to pull, which I don't think a lot of people have considered. And I'll give you the example here is that when you're tackling the finance strategy of your property investment portfolio, so this is how your borrowing is done, right? You've got the ability to actually influence both cash flow and profitability, right? So these are two different things. So if you're someone who's trying to influence, let's say, cash flow as an example, right, you might refinance all your properties onto new 30-year loans.
Yep.
And in doing that, you would bring down the payment per month because it's a new, longer 30-year loan, and then in turn, improving the cash flow on a property. Am I explaining that well enough? Pull me up if I'm not.
You definitely are. Yep.
Okay. Now, on the other side of things, let's just talk about like a profitability move, though, is where you would actually change something where you might not get the biggest cash flow increase, but you're actually going to make more profit per month, which I think is a really big difference. Really, really big difference. So one of the things I spoke to my broker about and was a really interesting conversation, he's like, well, if you were to change some of the way your properties are financed from interest-only terms to principal and interest, you can actually bring down some of the rates on your loans substantially. And I did the maths on this, and this was a huge one from my point of view. So noting this is not good for cash flow. I'm actually going to lose cash flow by changing loans from interest only to principal and interest. But because I'm getting a lesser rate, the profitability of my property portfolio is going to go up substantially. So at the time, I had roughly half of my properties on interest only. And then what we actually look to do is move them all to principal and interest. Now, do you want to know the difference in some of these?
I'm excited. I loosely know, but I'm excited for everyone to hear exactly what the difference is.
Yeah, so the difference in doing so and doing it across the portfolio was close to 1%, 0.9 in some cases.
What? So you'd refinance, essentially, I'm going to try and simplify this. So essentially, quite a few were on interest only, and then just by changing them from interest only to P&I, assuming that same bank, same everything, it's just like a phone call, hey, just change this from interest only to P&I now. It was a reduction in some circumstance of like a 1%.
Absolutely. And my mortgage broker did work some magic on this as well, because some were easy. They just swap them over like no worries. And others you might have to do a bit of a refi setup, and it is a bit more of a process.
Did you change any banks?
No, it didn't change a single one, although I think I threatened that repeatedly.
The default threat. Got it.
We'd be a very valued customer. So let's do some maths on this. Let's expand this out, right? If you've got $1 million in debt, right, and you're paying, let's just use really round numbers here, you're paying at 6%, which is roughly what's out there at the moment in the market, right? That's, when you look at it, it's going to be like 60 grand a year.
Correct.
If you're able to get that down to 5, that's 50 grand a year. That's 10 grand a year. That's $200 a week. Difference, which is substantial. Imagine your rent going up $200 a week.
Yeah.
So,
and then to your point, the reason that there is a difference in cash flow is that you're now using cash flow to pay down the debt, because that is how P&I is structured. So you pay the interest and the debt component, which is why from a cash flow perspective, it's very different from a profit perspective. Noting everything you put into paying down principal is essentially going in your back pocket because it's yours.
Yeah, so you lose the liquidity.
You just
right?
lose
it's just the liquidity loss. You're not losing the money. It's just you're paying down the loan instead of it accumulating potentially in an offset account for someone.
Yeah.
All right. So I looked at this strategy from here, and I don't have $1 million in debt. I got close to $4 million in debt.
Yep.
So when we're talking the difference in 1%, like this is massive for me. So I then looked through all of these things, and this is something someone would want to take into consideration. This is not a good strategy if you need the cash flow. If you don't have strong buffers on your properties and good emergency funds and things like that, like if you're low on liquidity, this could be a terrible idea for you. This could be a terrible idea in general. Like you would want to speak to a mortgage broker and get some really good advice around this if it's something you would look to approach. But in the case of myself, I'm looking at this individually and just going, how much easier would it be to fight rate rises if I suddenly had properties with the rent going up $200 a week?
Yeah.
Like when I look at my P&L and my balance sheet, is this going to move me into a position where it's like going to make a substantial difference? And I'm like, this basically takes off like the last 3 rate rises for me. So I did it.
And it seems like you're happy with what you have done.
Well, I think this is just one of the unique ways you can start to get a little bit more strategic with like being active in this.
All right, fellow property investor, if you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.